and welcome to Nippon Life India Asset Management Limited Q2FY22 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rushad Kapadia from ICICI Securities. Thank you, and over to you, sir.
Thank you, Margaret. Good evening, ladies and gentlemen, and welcome to the Q2 FY22 results conference call for Nippon Life India Asset Management Limited. We have with us from the management Mr. Sandeep Sikka, ED and CEO, Mr. Prateek Jain, Chief Financial Officer, Mr. Saugata Chatterjee, Co-Chief Business Officer, Mr. Ashwin Duggal, Co-Chief Business Officer, Mr. Arpanagya Saha, Chief Digital Officer, and Mr. Hiroshi Fujikake, nominee Nippon Life Insurance. So without further delay, I would now like to hand over to the management for their opening comments. Thank you, and over to you, sirs.
Good evening, everyone, and welcome to our Q2 FY22 earnings call. We have with us our CFO, Prateek Jain, Chief Business Officer, Saugata Chatterjee, Chief Digital Officer, Arpan Saha, Head Lead Partners and Client Groups, Nitin Gupta, and Fujikake-san, nominee from Nippon Life Insurance Japan. Overall industry assets continued the positive momentum in the quarter, driven by increase across asset classes. Also, the continued participation by individual segment indicates confidence by long-term investors in mutual funds. We expect the industry to maintain its growth trajectory in next 3 to 5 years. At Nippon India Mutual Fund, our priority is to be future ready and to capture the long-term opportunity. As stated earlier, we are confident of regaining our market positioning as well as recreating and reinventing by continuously innovating and disrupting ourselves. Towards these goals, I'm happy to share that our market share rose by 21 basis points to 7.33 in H1 FY22. AUM increased by 33% to rupees 265 billion. The increase has been driven by improved fund performance, robust risk management, and wide distribution networks. As stated in earlier interactions, consistent growth in assets is always preceded by improvement in qualitative parameters such as expansion of investor base. We increased our share of industry unique investors to 32% with an addition of 1.8 million unique investors as compared to 4 million for the industry in H1. Also, a share of industry's retail folios grew from 10% as on September 2020 to 13% as on September 2021. In Q2, the NFO of Nippon India Flexi Fund received an application of over 250,000 investors from approximately 2,400 cities. It is a huge testament to our superior brand recall, granular retail base, and strong distributor connect. Also, I would like to reiterate that even in the future, we will focus on strong asset growth, but never at the expense of profitability. In line with our investor-first philosophy, we expect to launch several innovative products in future. For example, Taiwan Equity Fund has received the SEBI approval this month. It's the first of its fund in collaboration with Taiwan's largest asset manager, Cathay Site. Through this fund, Indian investors can access the dynamic and growth-oriented Taiwanese market. Other such offerings in the pipeline include S&P EV Index Fund and Nifty Auto ETF. In total, we have filed 8 schemes for regulatory approvals. These products will provide investors more value-creative avenues to diversify risk and generate sustainable returns. Driven by keen retail focus, we have one of the largest retail AUM in the industry at rupees 777 billion. The contribution of retail AUM to total AUM is amongst the highest in the industry at 28% as compared to the industry, which is 23%. We are amongst the leaders in the beyond top 30 cities category the category contributed an AUM of rupees 488 billion. 18% of the assets are sourced from these locations as against 16% for the industry. As on September 30, 2021, 68% of the individual assets have a vintage of more than 12 months. The annualized systematic transaction book is at rupees 78 billion. On a gross basis, the systematic folios rose more than 436,000 in Q2. In volatile markets, folios with lower ticket size have demonstrated longer vintage and better stickiness. Today, Nippon India Mutual Fund offers industry's best suit in passive category. With strong growth in industry's passive assets, our ETF ecosystem is already in place and far ahead of its peers in terms of investor base and in mind share. In this segment, we manage an AUM of rupees 448 billion and have a market share of 13%. Excluding the EPFO allocation, which goes to two PSU mutual funds, we are the largest ETF player in the country. The Gold ETF is the biggest fund in the category with assets in excess of rupees 60 billion. Nippon India Mutual Fund's share in industry's ETF folio rose to 58%. In Q2, we added 1.7 million investors and accounted for 79% of the total folio addition in the industry in this quarter. NIS has 70% share of ETF volumes on both National Stock Exchange and Bombay Stock Exchange. Our ETF average daily volume across all funds is far higher than the rest of the industry. As a diversified asset management company, we have begun to grow non-mutual fund business segments over the years. Along with the government mandates, we manage assets of rupees 1.3 trillion in non-mutual fund segments. The offshore business has assets of rupees 117 billion under management and advisory. Leverage Nippon Life Japan's global network, we continue to ramp up our international presence. As mentioned earlier, the Taiwan Equity Fund is a step in that direction. In our AIF business, we manage Category 2 and Category 3 AIF across various asset classes. We have received approval from SEZ authorities for setting up AIFs in GIFT City. As of September 2021, Nippon India AIF has raised commitments of rupees 40 billion across all funds. Online and digital assets have become strong source of investor acquisition and communication. Our strong digital acquisition and engagement framework with targeted focus-oriented campaign is driven through cutting-edge tools like Adobe Campaign Management. These initiatives have helped fuel consistent growth on our own storefront and various other conclaves. The focus is towards creating a digital experience that is friendly, futuristic, and frictionless for our partners as well as our investors. In Q2, the digital platforms contributed to 53% of our total purchase transactions. Over 700,000 purchases were executed through digital assets, an increase of 55%. Nippon India Mutual Fund has a diversified and a nimble distribution base. As on September 2021, we have approximately 82,000 distributors in parallel with us. The mutual fund distributor base rose to over 81,700 with an addition of 2,000 in this quarter. We have an ongoing tie-ups with 20 prominent digital partners. The direct channel contributed 54% of the mutual fund AUM. Of the distributed assets, share of MFDs was 57%. 82% of the distributed assets are contributed by individual investors. NINF has a wide presence through 270 locations across the country. We continue to review our existing branch network and future expansion plan. Given the new normal, our marketing efforts are increasing more on the digital channels, which are more cost-effective as against offline advertising. Now on our financial performance. For the quarter ended September 30, 2021, the profit after tax was rupees 2.1 billion, an increase of 47%. Operating profit increased by 46% to rupees 1.9 billion. Operating profit as a ratio of average assets under management rose from 25 basis points in Q2 FY21 to 28 basis points in Q2 FY22. Our aim is to create sustainable value through growth across asset classes cost optimization initiatives, resulting in expanding favorable operating leverage. We continue to grow organically through physical and online channels. Additionally, we remain open to evaluate investments in strategic opportunities to add to the profitability or complement our existing businesses. In today's meeting, the Board of Directors approved an interim dividend of rupees 3.5 per share. As a signatory to UNPRI, world's largest voluntary sustainability initiative, we are in process of incorporating ESG principles across all facets of business. Also, we have taken several initiatives to ensure long-term health and safety of our employees. Dedicated camps, hospital tie-ups were arranged for vaccination of employees and their dependents. A comprehensive family plan, both in terms of financial as well as emotional support, is in place for affected employees. Apart from ongoing measures on climate conservation, we take regular steps to enhance data protection, ward off cyber risk effectively, towards making our overall risk control and governance framework more robust. A larger impact of digitization on our CRM framework has helped us to improve customer experience. In this quarter itself, 74% of our non-commercial customer transactions were handled without any human intervention. To sum it up, I would like to reiterate that at NAM India, investor centricity remains the key theme. We strive to deliver complete product suite customized to the investor needs, superior fund performance, and effective servicing based on the comprehensive digital ecosystem. We are confident to continue a trend of profitable growth in the coming quarters. With these comments, we are happy to take your questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Okay, congratulations on a good set of numbers. So I had, two broad questions. One was, like we've been trying to understand this for a while. When we see, improvement in the equity mix in the overall, AUM. However, at the same time, we are seeing, slight drop in the realization. Can you explain us, how should one look into it? Is it, because of the new NFOs that, realizations are dropping, or is it because of the, what is the, broadly the reason for the drop in the yields? That is question number one. Second is on, overall environment in terms of, what we have been hearing is that there's a lot of discounting or, very high commissions going to the distributors for the new NFOs. And, can you help us understand what is the situation, like is this, how sustainable is that in this environment to, come up with a lot of NFOs for the industry and for NAM India? As, in the opening remarks, you had mentioned that we have lined up like some 8 new NFOs, right? So like in the environment where, the commissioning has been very high for the entire industry, how does that mold from the, realization and profitability perspective? Thanks.
So I'll take the second question first, then I'll request my colleague Prateek to talk on the realization. I think from our perspective, as we mentioned, about the NFOs in my opening comments, our strategy remains that we will not be launching NFOs for the sake of garnering AUM. Our approach remains, we will continue launching products which we feel there is a need in the investor portfolio. Out of the 8 products that I talked about, 7 are ETFs, where there is no distribution fee. So our approach remains being customer-centric, launch products which we believe there is an appetite in presently or in future. Having said that, we also remain, as you've been hearing consistently, our approach will be between growth and profitability. Our focus will remain on profitability. With that, I'll request Prateek to talk about the realizations.
Yeah, so as mentioned by Sandeep, you are partly right that look, the new NFOs which have contributed to almost 50% of the new flows in the equity this year in the first 6 months, most of them have come, at a very high expense. And, we have remained away from such raising of assets. And also, Sandeep mentioned that, look, we continue to remain focused on our profitable growth. And in line with this, that there is, we have been, saying that, look, there will be a marginal decline in the yield over a period of time due to 2 or 3 reasons. One, because obviously as the asset size grows, our realization is likely to grow down. Also, the fact that new assets what we raise are comparatively, at a higher or a full trail commission as compared to the old assets. And the third aspect is that, of course, there has been an increased competition within the distributor fraternity in terms of the brokerage being offered by the competition. So all three have been working in it, but I think we have been balancing it out, and we'll continue to do that. We are not going to grow at any cost. For us, sustainable, profitable growth remains the key mantra.
Sure, thanks.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hi, sir. Congrats on great set of numbers. Firstly, the first question that I have was on the ETFs basket and the passive. Basically, you're planning to launch around 7 new ETFs or index funds. So overall, what would be the yields of these products? In a sense, I would rather ask a question from a 1-year perspective when all these would be launched. What will be the overall yield of this basket per se? That would be my first question. Second is more on the ESOP cost. And in this quarter, we had some 47 million of ESOP cost coming during the quarter. How do you see that trending? And lastly, the reason for the surge in other income. These are my 3 questions.
I'll request Prateek to take these 3 questions.
Yeah.
So in terms of the ETF basket, we have been maintaining that, X of CPSC and X of gold, we have close to about 15 to 17 basis point of earning. It all depends on, what kind of product we're launching and also, the competition. And as Sandeep mentioned that, depending on the overall yield expectation, what is right for the customer, we will be pricing our ETF accordingly. As you are aware that, ETF actually, means 3 things. One is the overall return being generated for the customer, the tracking error, the expense ratio, and the last bit is the liquidity. Our focus remains to provide ample liquidity and, provide unique as well as, new products to our investors. So that's where we are, but overall, as I mentioned, that X of CPSC and gold, our overall realization remain in the range of 15 to 17 basis point. In terms of ESOP cost, if you see there has been, marginal increase compared to the last year. If you look at the overall, the salary increment is concerned. So, for the year, board has, approved 58 lakhs kind of shares, which is contributing to 4.6 crore kind of a hit for the quarter. So that would be, again, as you are aware that in the initial quarters, the hit remains slightly higher and then it keeps going down from the second year onwards. So this is where we are. We do not expect these numbers to significantly grow from here, and also that the past ESOP cost over the period would be declining.
I think also on the ETF, I would like to just touch upon, unlike other parts of mutual fund, in ETF, the pressure on pricing will not be there because effectively, as Prateek mentioned, even if somebody was to offer an ETF at 10 basis on lower cost, if the liquidity is not there, the impact cost for the customer is very high. So we clearly believe we are in a strong position because of the liquidity. And if you were to go to the slide 22 of our presentation, that gives you a comparative statement of all the liquidity of all the ETFs in the industry. So the revenue pressure in ETFs will not be there. Rather, we'll be in a better position going forward.
Yeah. Just one of my last question was on the surge in the other income that we've seen in the quarter.
Yeah. So again, we have been again this quarter as well, positively surprised by the buoyancy in the market, and as mentioned that there is a part of the seed capital in our equity funds, and also we have put higher amounts as part of the comfort capital to a lot of our ETF as well as the equity schemes, and so that has led to that mark to market kind of an increase. However, from the from March 2020, the kind of exposure we have in ETF, we have pared down our equity exposure substantially. So we do not expect much volatility in that, and the other income will remain range bound going forward, unless we see significant increase in the market.
So you're saying the bulk of the jump in other income is because of equity M2M in the quarter. Is that correct?
That's right.
Okay, because if I look at your slide number breakdown of the assets, 49 slide, there we have just shown that the equity share is just around 8%, right? So and that contributes such a meaningful jump in the M2M.
No, so this quarter again, we have further realized our investments. We have harvested some of our equity investments. Obviously, so you are looking at the amount as of September date, but during the quarter also we have redeemed some of our equity funds AUM.
Okay. All right. Thank you so much for all the answers. Thanks.
Thank you. Anyone who would like to ask a question, you may press star followed by 1. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening, everyone. Thank you for taking my question. Just following up on the other income jump. Last quarter, roughly about at the end of the quarter, roughly about 7% of the financial assets were in equity, right? And normally there is mark-to-market accounting. So realizing that gain shouldn't really make that much of a difference in your this quarter's P&L, because it's not that you're realizing, although you might be realizing a few quarters or a few years of gains at one point in time, but you've already mark-to-marketed it until the end of the last quarter. So it seems that there is some gap in that explanation. And
Madhukar, I just want to add, sorry, this one, I just want to add that on the fixed income side also we had an elevated yields because if you see some of our schemes, where we had invested and we have continued to remain invested on the trade side have, for this quarter, has given a comparatively better yield. So that also has got mark-to-market impact, into our financials. Especially on the corporate debt and the credit funds.
Right. Has there been any recovery in the credit risk funds?
Yes. So there has, which we have intimated as well in the past, there has been a recovery on some of these stressed assets, and which has also resulted in that elevated yields.
Yeah. So got it. That clears things up. Yeah, and the admin and other OPEX has jumped a little bit this quarter. Anything unusual over there?
No, nothing significant, Madhukar. As we had mentioned that once the mobility comes to normal, there will be a slight uptick in the expenses. And if you see the last quarter was, we were completely working from offices across geographies. And, obviously, so there is marginal increase. And also, if you would have seen, there has been some increased elevated expense on the marketing side. And also we had, one new fund offering. So all those contributed to some marginal increase, which you have seen on the admin side.
Got it. Yeah, my other questions have been answered. So thanks a lot for this.
Thank you.
All the best.
Yeah, thank you.
Thank you. Anyone who would like to ask a question, you may press star followed by 1. The next question is from the line of Viraj Kacharia from Securities Investment Management. Please go ahead. Viraj Kacharia, your line has been unmuted. Please go ahead.
Yeah, can you hear me now?
Yes, you can.
Thanks for the opportunity and congratulations for good set of numbers. I have a couple of questions. First, just coming back to the question on the yield part, the revenue yield. Now, if you look at our own key flagship equity scheme products, TER, say, and compare that for September versus, say, August, we have seen a sharp cut in TERs. So the cut is, from say 7 basis points to even 19 basis points in some of the funds. And if we just, go back to your reasoning in terms of the drop in yield, there is no major change in, the trail has been going on, the shift to the trail mode has been going on for quite some time. And same has been the case for, there's not been any major change in the scheme AUM for each of these schemes. So it's not like that the scheme has changed to a different slabs altogether. So I'm just trying to understand that what is prompting us. Is the competition intensity too high for us to drive this sharp cuts? So is this one-off, or do we see this as more of a sustainable base going forward? So something you can comment on that. Thank you.
So, there are two parts to this one. In this year, what we have done is that some of the scheme-related expenses, relating to transaction costs, etc., also as part of, better disclosure and governance, we will be debiting into the scheme itself. That's one which we have decided as part of the board deliberation. Because of that, we would have carried out some adjustment to those expenses. But on the net yield, it is not going to impact. It is just that on the gross realization basis, we might have, done, there will be some impact. Also, technically, at times, to push some of our schemes, we do make necessary changes. On some schemes, we increase our TER, and some schemes, we, decrease. So this is more of a tactical thing which we keep doing it actively in consultation with our sales team. But predominantly some of it you will see that our expenses which we used to have it as part of our admin expenses will be more and more transferred to and also the allocation will be changing as per the for a better disclosure.
So to understand this a little better, the change in the gross yield, which we also report in the fact sheet and other material, how much of that impact will be pertaining to this change in accounting which we are talking about? And when you say tactical, is it just a promotion scheme one time in nature, or this is like a more sustainable trend going forward?
No, these are like, as we say that, we sometimes run contests for a quarter and, sometimes for a month. So it is all, depend on that. So, if you see that, in some of the schemes where we are seeing, or there are flows coming in and, performance is good, we do these, changes, which is allowed as per law. And, this is again, keeping the focus on overall profitability. And also, balancing the growth versus profitability, we keep making these changes. However, at the same time, we try and ensure that, the overall yields are not materially impacted.
And the change in accounting, which is driving this impact on the gross, how much would that impact be? Because, it's not just one or two scheme, major equity product flagship schemes have seen a sharp cut in yield. So that gives a materially different picture than what you're saying. That's why I'm asking.
It would be about 1 basis point, maximum about one basis point in the equity schemes, for that transaction cut what we're talking about.
Okay. So the majority of the cut is basically to drive volumes or to deal with the competition landscape, basically. Second question is...
combination of factors. One is the, the drive what we're doing it, the, increase in the AUM wherever it is there. And the third part is that, because of the churn, let's say if fresh flows have come at a higher cost and, there has been side bit of the old assets getting churned. So, it is a combination of all these factors.
Understood. Second question, which I just want to understand, is, if you can give some color on market share, especially in equity segment. in T30 versus B30. So how has that changed, say 6 months, year or 2 years back versus now? And added to that, just two more elements is if you can also dwell down on how is our market share behave in retail, HNI or corporate level, and any distributors we have added in T30.
Yes. So I'll take that one. So broadly, if you were to look at our market share, overall market share has gone up by about 22 basis points, and we have added about in last 1 year about 24 lakh new investors. Majority of them are retail. As you are aware, I think over the last 1 year, our equity fund performance has also been improving, and today is in quad quartile. The more difficult part of customer acquisition, which is getting retail investors, which are more sticky, that part is already into action and motion. And I'm very confident now the market share will also come with a lag. As the performance comes, the top-up comes, the more SIP comes. Even if you were to look at in our own presentation, slide number 30, if you see on a quarterly basis, on a month-on-month basis, our SIP book for the July was 600 crores, then it became 630 crores, then it became 650 crores. So directionally, we are going in that direction. So I think, but at the same time, in line with what Prateek also mentioned earlier, we want to grow, I think, garner assets in smaller citizen towns, smaller ticket size because they are sticky, and we want to also be very conscious of the cost of acquisition because we don't want to go overboard there. So I'll leave it at that, and then if there are any further questions. But broadly, one thing you'll see is, from our perspective, at this point of time, the majority of, also onto your question, the 22 basis point increase in market share that has happened, has majority happened in debt. Equity has been flat. But as mentioned earlier, since the investors have started coming in, we expect the AUM also to go with a lag effect.
But any perspective you can dwell into in terms of T30 position, because I think that's where we kind of lacked because of the issues the group related of the erstwhile promoter. So just trying to get a perspective, especially, how is that market share or positioning change? Any new large or institution distributor we would have added, or we have now been empaneled now?
Yeah. So we have added about 2,000 new distributors during this period, and majority of the investors, what I told, 24 lakh investors which have come, while I will not have the often breakup, but broadly very high percentage of that will be, majority would be from beyond 30 cities. That is number one. Number two, the fact that recently even our NFO, the fact that investors almost nearly 2.5 lakh to 3 lakh investors came from 2,500 cities and towns, gives the story that the investor has accepted the new brand, and the distributors, the relationship which were over the years, I think it remains very strong. And I think I'm very confident in coming quarters, as I mentioned, with the new investor base increasing and the market share increase of retail folios by 2% in last 12 months, that will clearly have a positive lag effect on the AUM and the market share of equity also.
Okay. Just last question. You talked in the earlier part of the call, you talked about rethinking on the network expansion, which we were earlier planning. Post-COVID, we are kind of rethinking on this. So just trying to understand, and in the presentation also, we kind of gave a slide maybe showing an improvement in profitability per branch, per employee, and similarly in terms of AUM per branch. So one is, what is the kind of throughput, you think the existing branches can kind of cater to before you needed to add either employee or further expand in those particular geographies? That's one. And relatively, how should one understand the existing cost base? So to what AUM this existing cost base, not just, overall operating cost base, which we can cater to, considering this change in our orientation on network expansion?
A very good question. I think from our perspective, as with reference to something else on the financial data, there was a question to Prateek on the cost, and we mentioned at the last quarter, I think all the offices have opened. I think during the COVID period, there was the offices were closed, everything was digital. I think, but when this thought always came to our mind, should we cut down or should we relook at expanding? Because everything, the world was working on digital. But I think what we have realized, especially in the last 3 to 6 months, is I think both digital and physical are going to coexist. I think it's never going to be a case that when you go to the smaller cities and towns, I think investors are not as savvy as we think that I think everybody will go to the net and do it, because still this product requires a little bit of push. And to your earlier question of adding distributors, because distributors also like to be, I think serviced. I mean, their remote servicing doesn't work with distributors in smaller cities and towns. So at this stage, we are closely monitoring, and we have not taken any decision to either cut down branches or expand rapidly. But at the same time, digitally, we'll continue focusing, investing. Branch network, our assessment at this point of time is, at least in India for the next 10 to 15 years, you need both very strong digital and physical infrastructure to succeed in small cities and towns.
So the current cost base which we have, operating costs, our employee and other admin and all, what kind of AUM that can be catered to? I mean, before us looking to make further investments?
So I think it is the way we see it. I don't want to see it from a quarterly basis how it works out.
No, I'm not looking at quarter. I'm just looking over next 3-5 years. So the AUM, if it keeps on growing.
I think we are present in nearly about 270 cities. We believe even if we have to add, let's take a scenario where we have to expand our branch network. I think it will be not more than 50 to 100 more. But at that also, there's no decision taken at this point of time. Right now, we want to focus on digital, and our 270 branches are good enough to take care, to service on a hub and spoke model more than 1,000 cities and towns in India.
Okay. Last question, if I can squeeze in.
Please.
On the international business, I understand there was a COVID in between. There was a disruption related to COVID in between, and therefore the whole process in terms of integration with parent and capitalizing kind of went on a slow track. But it's been now, some time still we haven't seen the kind of leverage or the delta one would have kind of hoped in terms of, in terms of flows from international business. That has not really materialized for us, So just trying to understand where has been the limitation, what stage of that evolution we are now in.
So again, from our perspective, I agree with you, and I think in the last quarterly results also I mentioned, whether because of COVID or various reasons, there is less to show there compared to the way the domestic recovery has started. We do not want to give a futuristic statement, but there's a lot of work in progress, and you'll see us in the coming quarters, I think, as things materialize, because unlike retail, which is basically a complete machinery works, a lot of international mandates are binary, 0-1. I think they need to close. But the fact that I think today, I think when we talked about Taiwan, if you see our LOI with the Cathay, I think it is not only restricted to launching a Taiwan fund in India, but vice versa also. So I think you will see some action on it. I think I completely agree with you, your observation, which I had myself mentioned. I think it's taken a little more time because last 2 years the world was grappling a very different issue. Every country was grappling an issue in their home country. You will see some progress. I think maybe in the next 3 to 4 quarters, you will see some positive developments there also.
Thank you and good luck.
Thank you.
Thank you. The next question is from the line of Ravin Kurwa from ICICI Securities. Go ahead.
Hello, am I audible enough?
Yeah, please go ahead.
Yeah, sir. I just 2 questions from my side. So one will be on the new age partnership. So partners like Zerodha and everyone. How is the distribution model working over there? Means does it get clubbed under direct or in the regular AUM? And my second question will be, what will be their AUM contribution as on today? And one more question will be on this new product which we have filed on the SEBI. What will be the cost to us? It seems that in initial phases these products are typically expensive. So will they be like profitable products in the initial phase, or it will take time when scale comes in, they turn out to be profitable? Thank you. That's it from us.
Perfect. So I think all the new age distributors, I think whether Zerodha or anyone, I think we continue working with them. We clearly see all of them as an important partner, but not only for the mutual fund distribution, but also playing a very important role in the expansion of the Indian capital markets and deepening, getting new investors. While I think it will be not appropriate for me to give the individual market share of who's contributing how much, but I think the fact that as we mentioned, about 60% of all the new ETF folios which have come to the industry have come to Nippon is a testimony to the fact that I think during this period, the entire ecosystem of Zerodha and Equilinks, as they were opening new demat accounts, we were one of the beneficiaries of that. So I think we see all these partnerships very important. And from our perspective, very clearly, any distributor, any partner, any player in capital market who's getting an investor to the capital markets is going to be helping the mutual fund industry, and we believe we are in a very strong position to capitalize from that. To your second question on launching new products, most of the products that we are launching, I think there is no significant cost involved in it. But again, having said that, I think when we launch a product, we launch it from the perspective of the 5-10 years, not seeing it, how it works out in immediately the one quarter, because there's going to be build up. To let's take an example, we were one of the first ones to launch the IT ETF, and then various other ETFs. And today these funds are about 2,000 crores. Having said that, we'll continue launching new products. There will be things where we will be investing for future, and we will be willing to, we will not look at the cost for that 1 or 2 quarters. But none of the products or none of the initiatives that we'll do will be done with the objective to just gain market share at the cost of profitability.
Okay. And one more question. So when we say that, for the ETF, when we have the earnings in the range of 15 to 17 bits, this was ex CPSE and gold, right?
Yeah.
So if we want to say that, ex CPSE, what will be the realizations for those ballpark number?
Sorry, come again. Individual. Every ETF, I think it is a published number. So broadly, It could be, for some it is as high as 100 basis point, and for some it could be as low as 10 basis point. I think again, I would like to highlight the fact, when we talk of ETFs, cost, many times we give too much focus on cost, but cost is not the USP when you sell ETF. An investor will incur an impact cost of 2 to 3% if the liquidity is not there. So I think it's a very important part. I think it is cost is one of the factors, not the deciding factor.
Okay.
And when you have volumes, you are in a position to actually, in a stronger position to drive up the cost also.
Okay. Thank you. That's it from me.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, thank you for taking my question again. I just have one bookkeeping question. Can you give me the category-wise closing AUMs for the quarter?
Yeah, so that is, I think, should be available in the MV website as well. But we can ask Abhishek to give you offline if it's okay, Madhukar?
Yeah, that's fine. Thanks.
It's not in the presentation.
Right.
Thank you. Any other question, Mr. Ladha?
No, that's it. That's it from me.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah. Hi, good evening. Thanks for the opportunity. Congrats on good set of numbers.
Sorry, Nikhil.
Hello.
Yeah, Nikhil.
Hello, am I audible?
Yeah, Nikhil.
Yeah, my was on the customer acquisition, which we do through the new age platforms like the Grows or the Zerodhas and all. Do you sense the behavior of this customer being more finicky in terms of a higher churn? Why I'm saying is because the way these platforms are basically advertised is the ease with which you can trade and transact. And if the customer is seeing that somewhere else is getting better NAV or something of that sort, he can churn easily, which is what they pitch on, the product pitch is. So do you see that the churn is relatively higher in customers who are coming from these platforms, or is the churn equivalent to what we've always seen through the offline or the distributor model?
It's too early to comment on that because a lot of these have just started coming in, a lot of this. But I think one thing we can clearly see is, I think you have to differentiate investors in two categories. There are going to be investors. Now let's take you talk of Zerodha and the broking platforms. I think majority of the investors come in ETF. And, out there it does not matter. Even if somebody was to trade, it does not matter. He trades in one, moves to something else, then he moves from small case in a different basket. It's a very different number. But overall, I think what we have seen, irrespective whether it is a investor coming retail, online or offline, smaller the ticket size and the SIP investor is the most sticky investor. That's something universally we have seen till now.
Okay. Because where I'm coming from is if the ease with which the movement happens becomes easier, the strength of the brand does get diluted. So if he comes through your own platform versus he comes through a Zerodha or a Paytm, the platform would make a difference, right, in terms of the stickiness, or would you say it will be remaining same?
I think you have a very valid point. If someone is coming directly to our property, it is the brand stickiness is higher. But at the same time, more than the brand, I think we have to understand. I think ultimately the investor, whatever is good for the investor, he'll do that. So I think today, even if he's coming to platforms, Zerodha or others, if he sees the ETF liquidity is highest in Nippon, from there he'll come here. So it does not matter. I think what the investors coming online are a little more savvy. They know what is good for them. And from our perspective, I think again I repeat, smaller the ticket size, the SIP investor is the most sticky investor, and that's exactly as Pratik and myself, we replied in one of our earlier questions. Our focus remains on small cities and towns because we strongly believe the fact that the 24 lakh investors that we have acquired in the last 12 months, I think to top them up, to take them up, that's a very sticky business rather than trying to acquire only HNI investors.
Sure. And just one last question. I don't know if it's relevant or not, but if someone comes through a ETF platform and is seeing that the Nippon AMC funds are giving higher liquidity, does it provide an opportunity to cross-sell him into our frontline or the active fund, or do you think that's not the case because he's purely coming from ETF for a specific reason, and when he's moving to an active fund, he would look in a different way? Is there a cross-sell opportunity or not?
I think I will not say cross-sell opportunity, but there is an opportunity for a higher wallet share, because what happens when somebody comes into a mutual fund, typically he'll go and invest in 5 different mutual funds. But if he has to buy a Nifty ETF, I think he will only come to one. He does not go and divide it in 5 mutual funds because underlying is already the same. So I would, more than cross-sell, I think the moment you get an ETF investor, your market share, your wallet share is much higher in that case, because the investor does not want to over-diversify, just like in case of mutual funds.
And that helps you cover the low yields on the product over a lifetime. I
think from our perspective, the objective remains that I think we continue offering what is good for the investor, and we leave the choice with him, because there are going to be investors who will do it yourself. I think he's matured enough to understand where there's liquidity, how to ignore that 5 basis point cost and look at the impact cost of 2 or 3%, which can have a far-reaching impact on his portfolio.
Okay, just one last question. Sorry to dig on this. Is the type of customer who is coming into ETF versus on active, is it different? Like the way in a debt market, if someone is coming, he would be more from a institutionalized or a larger size. So in ETF, is it a similar way, or in ETF the mix of retail and institutional would be similar to active fund?
So I think in ETF, the debt portion is more HNI and institutional, but the equity and the gold, I think, because as I mentioned earlier, our gold is one of the largest in I think it's primarily retail. So again, it keeps changing. It's not one size fits all. If it is a multidimensional thing, segment, there could be ETFs in retail which are very, very sector funds, I mean, that is very more, less retail, but more of HNIs, in our the IT, pharma, all these, banking. For ETFs, you have more people who want to take a sectoral call, tactical call compared to a normal ETFs. It's a very different approach. So it's not one size fits all, but one thing is for sure, ETFs in fixed income are more dominated by HNIs and corporates.
Okay, thanks a lot, sir. Thanks for the explanation.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Thank you for the opportunity again. Firstly, their NJ Invest raised around 5,200 crores in their maiden NSO, and that is one of the largest distributors. If I look at commission paid out in FY21, I think they contributed around 4% of their AUM. So does it any impact your distribution through NJ in any sense? Your thoughts on that would be helpful. Secondly, could you give some light on your customer base as to how many schemes of Nippon do they own on an average, whether it's around 2 schemes or 1.2 or 1.5 where they are? And last question would be on the equity side, within the market share trajectory has more been impacted because of lower share in inflows or higher share in outflows?
So I'll take the last question first. I think equity, as I mentioned earlier, this question has already come. So I think with the good fund performance over the last 1 year, we are starting to see inflows. Having said that, because when the markets run up over the last past 2-3 years, we were getting lower inflows. However, from the base, there was redemption because as the markets go up, investors tend to redeem. So I think again, if you were to say, because the earlier inflows are not there, now the inflows have started again, and I think that's why I mentioned earlier in addressing one of the questions, you will see the equity market share also going up in times to come. To your other question on NJ, as I mentioned earlier, I think from our perspective, the way we see the entire mutual fund industry from a long-term point of view, we'll have to do what is good for the investor. We'll have to keep the investor in the center. And also to the earlier question before this, I mentioned that in mutual fund, normally mutual fund investor will always diversify into multiple schemes and multiple AMCs, unlike ETF. So I think definitely if NJ doing it, I mean it can impact the distribution scenario in India, but we clearly believe the kind of brand and the reach that we have, I think we'll continue getting our market share.
Okay. And I had asked one more question about the average holding of a Nippon scheme with your customers. Any data there?
I think we'll not be able to give the exact number. It is shadow less than 2.
Less than 2. Okay. All right. Thank you so much.
Thank
For the last question, we'll come back to with the exact number because this will be a little.
Thank you. The next question is from the line of Viraj Kacharia from Securities Investment Management. Please go ahead.
Yeah, thanks for the opportunity again. And I just wanted to go back on the yield part. Not just for us, but if I look at other large incumbent players also, in last 2-3 months, we are seeing them being quite aggressive in terms of giving, higher commission payouts to the distributors. So is it that the competition that we especially say from the funds who have launched and seeded and scaled up in last 5, 7 or 10 years, and the threat of them becoming even larger and taking more higher share is now even more severe. Hence, this is the reason why we are kind of seeing this kind of a cut in the yields for those larger incumbent players, including us.
So see, if you see, I was just looking at data. Today we have 45 players, and way back in 2012 also we have 45 players. In between, 20 AMCs have actually changed hands, in terms of overall, numbers. And today, if you see, 30 of them are less than 1% market share. So, this is like, you will see this flickering. This happened in 2006-7 as well, and we being in there for almost now 2.5 decades, we have decided to stay away from these, assets, augmentation by paying higher commission. For us, profitability, profitable growth remains the key focus, and we'll continue to do that. And I'm sure, there are reasons for newer incumbents or some of the existing incumbents to, garner higher market share on the expense of profitability. That's their call, but I think we'll remain, focused. And also, if you see in an overall basis that in the last 10 years, the industry has grown 5x, and the larger players have continued to dominate that. And, I think, if we remain focused and, keep doing our work, I do not see there is any reason for us to, shell out higher commission, to grow our market share. So, that is what I would like to comment. Beyond that, I won't be able to comment on the competition strategy.
I think, Viraj, just to add to what Prateek mentioned, I think we strongly believe any business model by paying higher brokerage to a distributor or by charging lower fees on a product is not sustainable from a long-term point of view. So we will continue our profitable growth. I think we will not be, from our perspective, we see the volumes can double, triple, and multiple times from here. And our focus will remain not to get into any price war.
So the background to this is, I agree that, broadly the top 10 or the top 15, market share is by and large been stable, or they have actually consolidated in this industry. But if you look at the composition of the top 5 or the top 10, that has materially changed. So the guys who have, say, not there at all in 10 years back, they now have a sizable market share. Some of them are even ahead of us in terms of market share. And, it's even more amusing because you're, operating in an environment right now where the flows are quite healthy. The market is also quite favorable, and players are engaging in this kind of yield or increased payout. So, and we have also seen fairly that bit in our own flagship schemes. 15-20 bits cut is not a small cut, by any means. So hence, I'm just trying to understand, how is this kind of what is driving this change in behavior when everything is going with you in terms of the industry environment and flows?
I think, as mentioned earlier, every player will have a different strategy. From our point of view, this, I think, 15 basis on any fee scheme, I think Abhishek will come back to you offline. There seems to be a little bit of something, I think, amiss in here. Having said that, like I mentioned, our focus will remain. I think we see a big opportunity for the volumes to double, triple from here. And we will not be doing anything where we lose money. I think even if it's at the cost of market share. I think I'd like to reiterate our philosophy going forward.
Thank you, and good luck.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that's the last question for today. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.